It's sort of a rags to riches story. He went from exiting a company, had about $1.5 million sitting in the bank. Just think about that. You got $1.5 million in the bank. And then he flipped that into $2.5 million in debt. But then the best part about it is he turned that around, got completely debt free in 13 months. And all of that came about during the Great Recessions. But we're going to talk about a couple things that, he calls it the boring investor. But if you consider Warren Buffett boring, well, then I guess you would say this will be boring out for the rest of you. It's going to be enlightening. What's going on, everybody? Chris Naugle back with the Money School podcast. And by now, I think you already know this podcast is all about the truth when it comes to money and how to take back control of your money, how to be the bank. But today, we're going to talk about something boring, and that boring something is real estate. I've got an amazing guest with just oodles of experience in this space. It's sort of a rags to riches story. He went from exiting a company, had about $1.5 million sitting in the bank. Just think about that. You got $1.5 million in the bank. And then he flipped that into $2.5 million in debt. But then the best part about it is he turned that around, got completely debt free in 13 months. And all of that came about during the Great Recession. Some of you are probably too young to remember that, but just as a reminder, it was a really bad recession that I remember diligently and vividly because I almost went bankrupt. And I'm sure our guest Paul remembers that one like it was yesterday. So we're going to get into the rags to riches. We're going to get into what he's doing today, but we're going to talk about a couple of things that, he calls it the boring investor. But if you consider Warren Buffett boring, well, then I guess you would say this will be boring out for the rest of you. It's going to be enlightening and eye-opening. Paul Moore, welcome to the Money School podcast.
Hey, Chris, it's great to be here. How are you?
I'm doing great, doing great. So I think with an intro like that, the rags to riches, you exit your company, got $1.5 million in the bank, and then you're $2.5 million in debt, but then you flip it and you're out of debt again. So
Yeah.
we all want to know how that happened. So tell us that story.
Yeah, so I had made about $2 million in my exit, donated some to charity, and had $1.5 million in the bank. Exactly 10 years later to the month, in November of 2007, had $2.5 million in debt. My business partner came to me and he said, "Hey, I can't make my half payments on this anymore. I'm signing all the property and the debt over to you, my friend." And so that's when I really had 2.5. That included my mortgage and a vacation home and other stuff. But it especially included a 5-acre waterfront parcel that was worth 600,000 or 700,000 as is, but potentially almost 2 million if it was subdivided into waterfront lots. But there was no way to subdivide it. Anyway, I had a couple friends came to me and said, including my CPA's husband and another good friend, they met with me at a restaurant. I said, "What are you going to do? You're going to declare bankruptcy, right? What are you going to do?" I said, "No, we're going to give our way out of debt." And that's about the silence I heard on the other end of the table, because there was like, "What are you talking about?" And I went to my family, said the same thing. I said, "Guys, we're facing a serious situation." I had 4 young kids. I said, "I want to make this memorable. So we're going to start giving a set amount to some charities that we think are really important, our local church, etc. Every week, we're going to give the same amount of debt, same amount, and then we'll see what happens." And we were studying a guy named George Mueller, and some people who know history know that in the 1800s, he housed and clothed and fed 10,000 orphans. And he did that without ever intentionally raising money. The money just came in to care for him, to care for those orphans. So we're like, okay, let's just do something radical like he would do. So we started giving on January 1st, 2008. Now, Chris, it's important to understand, we didn't know we were about to plunge into the greatest recession since the Great Depression. We didn't know. We were hoping the worst months in 2007 were already over. Of course, the worst months were, the next year. And about 4 weeks into giving this set amount, which was quite painful, I ran into a guy at a Subway restaurant at Smith Mountain Lake here in Virginia. And I said, "Hey, I got this problem. I got this 5-acre lot. I would love to subdivide it." And he gave me a nugget of an idea that turned into this crazy idea. And 2 days later, I was sitting in front of the planning and zoning clerk at the county and showing her how I wanted to subdivide this land and how I was going to use one of their laws and turn it on its head to subdivide this land. And she looks up at me over her glasses, and she's a little older, and she says, "Mr. Moore," real sternly, "nobody has ever come to me in 30 years here with such an outrageous plan to use our law against us." And then she smiled and she goes, "But you did." And she goes, "I can't stop you, and I won't." And so we ended up, there was a lot of work left, Chris. We spent months with attorneys and soil scientists and surveyors, and we still had to pull 5 buyers together in these worst months of the Great Recession. But bottom line is 13 months later, we were completely debt free. We even paid off our house.
Wow, that's fantastic. And you did it just because of that one idea that that person gave you. And it's funny, I want to go back to the giving. And, if any of you have ever, when you were a child, then read this from your parents or maybe read it to your children, but the book called The Giving Tree, on how that
Yeah.
tree just gave and gave and gave, it's an interesting story. If you haven't read it, please do. But the whole universal law that I
Yeah.
think a lot of people don't understand is like you were giving, it was a painful thing that you were doing at the time. And then the Great Recession hit, which probably made it even more painful, but you just kept giving. So how it works is like a boomerang, folks. When you give, the universe must give back. Now, it's not going to give you back, exactly when you want it. It's not going to give you back exactly what you might want, but it's going to give you exactly what you need when you need it the most, which, Paul, that's your story. The universe, which it's a reciprocal force. You can call it the universe, you can call it God, you can call it all those things, but that's how it works, folks. And listen, Paul, I'll tell you something, I don't really speak enough about it, but we've been in some really hard times through our journey, me and my wife, and we did the same thing. My wife is very giving, so am I, but every time we get, in a pickle, when we a couple of years ago we got in a little pickle where we owed 7 figures in taxes 2 years in a row, which, hey, listen, that's a blessing, but it's also a curse all in the same time,
Right.
because when you don't know it. And most people would hunker down, they would get real stern, they'd hold everything back. What we did is we just kept giving. We pledged through our foundation to give and give and give to different rescues, different, we also do some giving to stop child trafficking, which is a near and dear thing. I know we're going to get into that. And we just kept giving, and you guess what happened? The money just showed up to pay the taxes. And listen, like,
It's
I'm
amazing.
not making this up. It just appears. So
Yeah.
I totally understand that, but I don't know if the audience fully does. So folks, just when you're staring, into the darkness, just understand the way out is to give. Always has
Yeah.
been, always will be. So with that being
Yeah.
said, didn't mean to kind of go down that rabbit hole, but it's just so important. Let's just talk a little bit deeper about that, because one of the things that you mentioned is that you say no a lot. You say no
Yeah.
99% of the time. What's the theory around that?
Chris, one of my big problems when I sold my company was I was an entrepreneurial investor, which meant I tried to get the same thrill out of investing that I did out of being an entrepreneur. I was 34 years old. I was extremely type A. And when I tried to slow down, I just got bored quickly. So I started saying yes as a default to every investment opportunity. Chris, what I didn't realize is everything looks good. Everything is presented beautifully. All the glossy brochures we used to have 30 years ago and the beautiful websites we have now, they all are made to make us say yes. And so I said yes. And I paid a dear price for that. That's part of the reason I lost a lot of money. And so over the years, I flipped to the opposite extreme. Warren Buffett says the best investors say no a lot. The very best investors say no almost all the time. And so Charlie Munger, Buffett's partner, was called Mr. No, was his nickname. He said no almost all the time. And so our company, Wellings Capital, has adopted that as our mantra. We just basically say no to almost everything. We looked at 745 deals last year. We said yes to 5, and we said no to the other 740. And our default is to always say no unless a deal and an operator can prove themselves.
I love that. So there's a lot, I think in every entrepreneur's life, I think in just about anybody's life, it sometimes is much easier to say yes than it is to say no. But what you'll find is there's only so many hours in the day, and you got to really start choosing and picking how you spend those hours. And when you have a family and things like that, well, that's where you spend your time. So there's only one thing you can do is just start saying no. And the
Right.
more you say no, the more comfortable you get with that. So that then when the right thing comes, the answer yes comes out, and then it's genuine, then it's the right opportunity.
Absolutely. I think the problem for me was I suffered from a severe FOMO, like, fear of missing out. And now our company says, no, we have FOMO, which is fear of messing up.
Well, FOMO is very alive in the marketplace today, as you well know, because we've been in the longest bull run in our history, and that has created a whole generation, or maybe even multiple generations, of people that know no downside. So we just talked about the Great Recession. We talked about how it really brought us to our knees and how bad it hurt, and we could probably talk the entire time of this podcast about that. But the fact of the matter is, and I might get this age wrong, but I think anyone 38 years old or younger has no recollection of the pain that that recession served out. They literally know nothing about the recession in terms of maybe, they remember some faint memories of their parents struggling, but
Yeah.
like think about that. 38
Right.
years old. That is almost two generations of
Right.
folks. I almost call them young folks, but I'm, 48, so I'm not too far outside of that. But they don't know the downside to the markets. They don't know a
Right.
recession. I have a strong feeling they're going to learn here very, very soon. But nonetheless, that has created just this massive FOMO in the market where they're saying yes to everything. And quite frankly, like they probably have done quite well saying yes. But when that monster shows its face, which it certainly will, it's cyclical. That yes is going to be definitely a pain for them. No question about it. So let's
Right.
talk a little bit about that. Now, you're big into commercial real estate, and you run 8 commercial real estate funds, to which you just mentioned, over 700 deals you looked at, and you said yes to how many?
5
5.
last year.
That's what I thought. You said yes to 5. So what those deals that you said yes to, commercial real estate goes far and wide. Talk about those deals. What do you like in the commercial real estate space?
The main thing we like is, Buffett says price is what you pay, value is what you get. And so we're looking for operators because we're not an operator ourselves. We're a fund manager, and we're looking for operators who know how to spot and then unearth and then utilize intrinsic value.
Oh,
And so that could be, for example, a self storage facility where the owner is a mom and pop. Their rates are, half of the market rates. They've got 100% occupancy as a result, or sometimes they might even have. We invested in one that had 80% delinquency, if you can imagine that. People were glad to stay there because they didn't have to pay. But the owner of the self-storage facility might say, yeah, we got 6 acres out back. We don't see any use for that. You get that too. And of course, there's a massive demand right now for industrial storage, boat storage, RV storage. So there's an intrinsic value that previous owner didn't know. Adding U-Haul and operating U-Haul out of there, selling locks, boxes, tape, scissors, bringing rents up to market rates, doing all kinds of things, putting an ATM out front, a propane filling station, a cell tower in the back, a billboard in the front, all kinds of intrinsic value that the mom and pop operator doesn't know about. And that's just one example in self storage. There's so many more.
I love that. And I think there's a lot of investors that have no clue what intrinsic value even is. I mean, any investor that invests in crypto, you don't understand intrinsic value.
Right,
I'm not saying it's a good or bad investment, taking a
right.
zero, middle of the road, but intrinsic value doesn't exist there. So if you want to learn a little bit more about intrinsic value, any book that Warren Buffett has ever written, or Munger or Graham, any of them, read their books. Every bit of their book is about things that the new investor doesn't know anything about, and that is fundamentals and good old fashioned intrinsic value. So I love that you
Right.
said that. But earlier when we spoke, you also mentioned affordable housing, meaning mobile homes, or
Yeah.
mobile home parks. How many of those do you invest in? What is your thought on the affordable housing space?
10,000 people are turning 65 today, Chris, and 6,000 of the 10,000 don't have $10,000 cash saved for retirement. A lot of them have home equity that they might be willing to trade in for a mobile home park lifestyle. There is a massive affordable housing crisis, but the problem is it's getting much worse. The slowdown in new development of multifamily this last year and a half, coupled with the increasing demand, is putting a 3 to 4 million unit gap out there. And that means, and especially with apartments being what, $800 to $1,000 on average less than home ownership right now, that gap means that there's going to be that affordable housing crisis is going to skyrocket. And there's just no way to fix it that we know of. Mobile home parks, manufactured housing communities, whatever you want to call it, they're the only asset type we know that has a decreasing or static supply every year and a significantly increasing demand. And mobile home parks in general, there's 44,000 out there. They're generally owned by mom and pop owners. They generally are priced under market. The mom and pops are notoriously, that their lot rent is, sometimes 50, 60% of the market rate. And even at market rates, that's a fraction of the cost of a one-bedroom apartment in the same market. So mobile home parks have just tremendous opportunity. If I was going to pick one of the 6 asset classes we invest in and invest in that only the rest of my life, it would certainly be that one.
I couldn't agree more. And, it's funny, I grew up spending most of my childhood in mobile home parks because that's where my grandparents lived. And I didn't think anything of it. I know it's looked down on by most because it's not it's not all the glam and glory of the luxury apartment complexes, but kind of what you said. Paul, I just did a really big research project that turned into a podcast and also a YouTube video. I'm kind of a research nerd, and I found what I think I call the next housing crisis, and it's not the housing crisis like 2008, but what it is exactly what you just said. Most real estate developers got it all wrong. All wrong. And the numbers don't lie about that. So right now, there's 500,000 luxury apartment units under construction at this very moment. And, there's a massive, massive amount of supply in luxury apartment complexes. Let's just pick on the Sun Belt states of Florida and Texas. Like right now, their delinquencies are into the high double digits right now. So if you ever look at, pro formas, folks, which is basically where you put all the numbers together to see if a project is viable, pro formas typically will account for a vacancy factor of 3 to maybe high side of 5% is what I'm typically seeing. And now, right out of the hole, these luxury apartment complexes that are opening, that are being completed, they're realizing in Sunbelts upward of 15 to 18% vacancies, where in just the nationwide it's 8%, which is already well above what would be the kind of tippity top, if not even danger zone of vacancy. So these luxury apartment owners are having to discount and give free rents, but yet what they thought they were doing is filling the housing need because there's a massive housing shortage in the millions of housing units needed. But unfortunately, they didn't do the research, or the data was wrong, or something went wrong. And I tell you what went wrong: the banks, because the bank said, nope, we want this use. We want multifamily luxury. We want mixed use. They want all the fancy pro formas to show on their books. But what the need was the entire time was affordable housing. And as of today, remember I said there's 500,000 luxury units being completed, luxury units being completed right now. How many affordable units do you think are being built right now?
Very, very few.
6,800. And the need
6,800?
6,800. I just did this huge research project.
Worse than I thought.
6,800 affordable housing units. And I dug deeper. I said, well, how can that be? How did they get it this wrong? The pro formas, when they did for the affordable housing, they're just thin margins. Like they just didn't have the juice to get the banks interested. So to get the financing, these projects had to flip over to be luxury units or multi-mixed use. So those are suffering. So that's the next housing crisis. And put on top of that, the cliff right now, the real estate, commercial real estate mortgage cliff that's going on. I mean, most of the apartment complexes started 3, 5, 7, 10 years ago when rates were really low. And all these mortgages now are coming to their maturities because most of them were a 5, a 7, or a 10-year maturity. And they're resetting at today's interest rates, which is a doubling effect. So not only are they witnessing lower cash flow, higher vacancies, but now they're about to get slapped, and many of them are right now. But the big move starts in 2026, where all these mortgages have to refi or have to mature, and they're going to be doubling their mortgage
Yeah.
rates. It's going
Yeah.
to be a massive problem. And I'm glad you're on the side you are with storage and also with affordable housing, because I just think that's one of the biggest opportunities, like you said. So I didn't
Yeah.
mean to go down a hole there. I was going to hopefully be able to debate you a little bit in terms of what you thought was coming, because I thought when I read it, commercial real estate didn't tell me what you were investing in. I thought you were going to have all these luxury apartment complexes. I thought that
No.
was going to be a fun little clash, but I think we're both on the same side on that one.
Yeah, I'd love to get a copy of your reporter podcast. Please send it, Chris. That's good
You got it.
stuff.
You got it. Yeah. Well, let's turn over to Warren Buffett. Now, it sounds like you've done a lot of research on Munger, and, God rest his soul. He passed away not long ago. And, Buffett now is way up there in age and just turning over the reins to, the next in line for Berkshire Hathaway. But he's just had an incredible run. You've read a lot of his books. You've studied them. Like, what are Warren Buffett's rules to real estate?
Yeah. So, one thing I would say is, Chris, that boring investors attain true wealth. And I was talking about being an entrepreneurial investor before, trying to get the same excitement from investing that I got out of being an entrepreneur. But boring investors attain true wealth. Warren Buffett said that if you don't learn to make money while you sleep, you'll have to work until you die.
He
And
sure
I
did.
found, Chris, you and I both come from a background of flipping houses. I found that when I was flipping houses, and this is my fault in part for sure, but I was just doing transaction after transaction, but I was not building up any true wealth, making money while I slept. And, I realized that I wanted to get into something like commercial real estate throws off money while I sleep. And that's one of the things I love about it. But it's also more boring than flipping houses. I mean, let's face it, flipping houses was fun. There's TV shows about it, I heard. Anyway, Paul Samuelson was the first U.S. economist to win the Nobel Peace Prize. And he said investing should be boring. He said investing should be like watching paint dry or watching grass grow. He said, if you want excitement, take $800 and go to Las Vegas.
Well
So
said.
boring investors attain true wealth. Boring investors enjoy real freedom. I used to joke around and saying, hey, I'm an entrepreneur. I get to work any 80 hours a week I choose. And, that wasn't freedom. And my kids really suffered because my kids are now 20 up to 31 years old. And, they grew up with a dad who was distracted, who was on my BlackBerry or iPhone, in the evenings and weekends. And I was not really enjoying real freedom. And I regret that now. And now that I'm 61, I'm taking life easier. I'm slowing down. I'm realizing, the hidden costs. The hidden costs of being an entrepreneurial investor, which is also known as a speculator in some ways, can be devastating. I've got a friend named Kevin who lost relationships, he lost productivity, he lost sleep, all because he was obsessed with his stock option prices and constantly watching the tickers and doing the math over and over and over again. He didn't make any more money from it. He probably lost money from actively trading like most people do. And he lost focus. Now he's put his money into, ETFs and commercial real estate, and he spends his time sailing on the Puget Sound outside of Seattle, and he's enjoying his life. He's avoiding the hidden costs. And, Buffett and Munger talk about that. Charlie Munger said, why do people think they can succeed at actively trading? They don't make their own egg beaters or design their own lawnmower engines, do they? I love that quote.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
Munger was so just eloquent in everything he said, but so simple. I think that's what I love about the two of them is everything they say has so much meaning if you listen to it, but it is so simple. And to your point, boring, very boring.
It is. Munger was, Munger and Buffett both, they said, we don't want complication. If it's too complicated, if it's not simple, if it's not easy to understand, it's going in the too hard pile. They said, we don't want to jump over 8-foot hurdles. We want to step over 1-foot hurdles. Munger also knew that they might be wrong. He realized that they made a lot of mistakes. And you would think, so Bill Gates and Warren Buffett said that Charlie Munger was the most brilliant investment brain on the planet. What does the most brilliant investor on the planet do, Chris? Does he design super complex algorithms? I would think so. Or does he figure out some using AI strategy to invest smarter than everybody else? I would sure think so. No. Munger spent his hours and days and years dwelling on other people's repeatable mistakes and strategizing how he and Buffett could not make those same mistakes. He said, if you avoid mistakes, if you keep things simple, you'll likely make a fortune. And when he made a mistake, he was honest about it. He said, he stood up in front of 40,000 Berkshire Hathaway devotees, and he said, we were horses' asses. We failed you. And it wasn't just false humility. He meant it. But he said, look, we're going to learn from that, and we're going to not do those things again. So you mentioned mobile home parks people looking down their nose at, Sam Zell's the most successful real estate investor, maybe of all time. And while you were a little kid and while I was a little kid, and our parents probably didn't think about anything about investing in mobile home parks, he was quietly snatching up mobile home park pads. He had 158,000 when he died a few years ago, 158,000 mobile home park pads. He was willing to invest in boring assets like mobile home parks.
Yeah, I mean, there's nothing more boring than that. If any of you have ever seen a mobile home, and the ones I remember back in the 80s are very different than the ones today. The ones today, have you seen the new mobile homes that you buy, like the prefabs? Yeah. They're freaking beautiful. But the ones back in the day, they looked and felt and sounded like a mobile home. I mean, pressboard was the wood that they used on the floor. So sometimes it was a little squishy. And, it's just interesting to think about that, because going back to those years, even when I was a little older and my grandparents died and their mobile home went up for sale, I could have bought that mobile home for probably 10 to 12 grand. Silly that I didn't, stupid that I didn't. But I think the bigger play was the dirt underneath, and just buying the pads, because it's just a concrete pad that they back this thing up on, strap it down, and somebody moves in. So it is boring and simple, but man, it works. And it is now and soon to be probably going to be one of the most popular types of real estate that people want, because there's just not enough of them.
Yeah. It's very true, and there's so many powerful strategies around that. Boring investors know how to invest in the gold rush. Chris, I don't know if you've taken an Alaskan cruise, but I did last year, and I stood on the very spot where 110,000 gold rush guys ventured off into the Yukon, and 70% never made it there. Of the 30% who did, only 4% found gold, and you know how that went. But, they probably if I was them, I would have looked down my nose at the shopkeepers, the hotel people, the saloon manager, the people who sold the picks and shovels for 1,000% markup. That's a true story. But those guys are the ones who got rich. And that the boring investors in the gold rush are the ones who got consistently rich. And I'm thinking back to my friend and I, we lost like $1 million total investing in wildcat wells in North Dakota in the oil rush, in the oil boom, the Bakken oil boom. We weren't satisfied making 10 or 20% returns. We wanted to do the wildcat wells that had a chance for 1,000% return. But a year later, we started building housing for those same oil workers, and we printed money for years, selling 300 square foot furnished rooms to these guys for $4,000 a month, and we stayed full. We made more money selling picks and shovels. So boring investors know how to invest in an oil boom or a gold rush. You know what I mean?
I do. Interesting story. A good friend of mine, Greg Reed, wrote a book called 3 Feet from Gold, kind of a spin-off of the Napoleon Hill stuff. But it's all about that. It's about a very wealthy man who was digging for gold, and he knew there was gold in the ground, and just it beat him up. Time went by, wasn't finding it, and finally, the kid who was pushing the cart around selling the picks, and he came by to see if he needed anything, and the guy said, "I don't want any of this. I can't. This is a bust. I'm done. Here, you want to buy this?" And he said, "Just give me whatever's in your pocket." The kid gave him whatever was in his pocket. 3 feet down from where that grumpy man was digging, this kid struck gold in one of the largest gold mines, that there was to date. And that is based on a true story, but you should read that book, not just because of the story of this guy and this kid, but just the meaning behind it. So many people never hit their dreams because they stop 3 feet from gold. That's that 70% that never even made it to the Yukon, let alone the ones that didn't find gold there. But you're right. Sometimes the riches, in acres of diamonds, that song. And then there's another story about a man who had a river in his backyard that he went through every single day. And then he got the bug to start looking for diamonds, had no idea what diamonds looked like, sold his farm, went off to hunt for diamonds, never found them, went broke, jumped off a bridge, killed himself because he, couldn't find any diamonds. Lo and behold, the farmer who bought his place was pushing a cart across this little stream, this little brook, saw something shimmering in the water, picked it up, put it on his mantle. Someone came over to his house one day and said, "What is that on your mantle?" And the guy said, "Just some rock I found in my stream." It turned out to be one of the largest diamonds in history. And he was sitting on the largest diamond field ever. And that is also another true story. Earl Nightingale tells that story well. So, it's just kind of all these things, folks. Sometimes, your riches are right under your nose and they're right before you. You're just not looking, or you're just always thinking the grass is greener on the other side. And it's kind of like what you're talking about with the boring investor. It's boring, but it's right there. Just find the opportunity. Now, you also have written a couple books, and I'll just name them off. Storing Up Profits is one of them. The Perfect Investment is another. And then you've got this new book that you're writing, which is based on these Warren Buffett rules of real estate. So if people wanted to find those books, where would they go about finding them? And do you want to talk at all about your books?
Yeah, Storing Up Profits is a book about self-storage. I wrote it in 2019. COVID delayed it. The publisher waited till 2021 to put it out, right in the height of when self-storage was going crazy. It sold pretty well. It was a Bigger Pockets publication. I had a show on Bigger Pockets for years on their smaller channel, Instagram, Facebook Live, and all that. And so that was good. The Perfect Investment's interesting. That was my second book. The Perfect Investment actually was written in 2016. I had a book on residential back in 2008. But in 2016, I put out The Perfect Investment. And about a year later, I went on dozens of podcasts, did dozens of blog posts for Bigger Pockets and my own company, and said, time out, I was wrong. The perfect investment's not perfect. If you have to overpay, over leverage, use risky floating rate debt, assume that in Howard Marks' words, trees will grow to the sky, meaning rents in Tucson will go up 9.8% every year from here forever. If all that had to be true, it's not the perfect investment. And we were finding competitors, Chris, who were, talk about luxury apartments, they were paying 30% more than the underwriting made, that supported. And they were actually flipping these apartment complexes in 2 years for double the equity, double the investor's money. And you know what we found, Chris? The more risk these, honestly, amateurs under 38 years old, no offense to anybody, but the more risk they took, the more profit they made because they used higher leverage. They used floating rate debt with no prepayment penalties, and they were making a killing for their investors. But I knew the music would stop someday, and of course it did. It was spurred on by the spring of 2022, the first of, I think it was 11 interest rate hikes that exposed these guys, and I'm not knocking any of these guys. Some of these are my good friends, and it could have happened to anybody. But Warren Buffett, famously said, sure, the rising tide will lift all boats, but someday that tide's going to go out, and then we'll see who's skinny dipping.
Absolutely. I love it. You got all of those quotes. That is amazing. So Another thing you do, I wanted to hit on before we get to the end is you do a lot of higher purpose stuff. Now, I know earlier we mentioned giving and giving deeply, and that's very much God's way. And now you found another way to give, and that is for combating human trafficking and bringing awareness to human trafficking. And I just read an article the other day, and I have a 5-year-old daughter, and if I'm not, don't hold me to these numbers, but it said every single day there's like 1,200 children that go missing. And maybe I'm low on that number, but if it was one child missing, that's too many. So call it 1,000, 2,000 children go missing every day. And it just seems like every time we think we're going to crack into this, I don't know, Sean Pitty, Diddy and all those guys, like you hear all these rumors of it. And I'm trying not to put names out there, but that one is front and center because it was in the news again today, human trafficking and child trafficking. But yet when we get to almost cracking the surface, it just goes silent. And it just seems like this just keeps happening and happening.
Yeah.
So there's, that is the devil at work.
Yeah.
I can't even fathom how anyone could even entertain that, but yet it's obviously a big thing. So can you just talk a little bit about why you're so passionate about helping that cause and bringing awareness and hopefully making a dent in human trafficking?
Yeah. So I like to say that boring investors invest in the unseen realm where there is no apparent return on investment. William Wilberforce, he was at the height of his career about 200 years ago. He was in England and he sacrificed his great wealth, his reputation, his social circle, his friendships, ultimately his health, all to fight slavery in England. And he eventually got the slave trade outlawed. And then 3 days before his death, they outlawed slavery as a whole in England. I think it was in 1833 or so. And that spilled, of course, over to America about 30 years later. And so we're so grateful for people like William Wilberforce. But here we are 200 years later, and there's 49 million enslaved individuals in the world. And like you said, it's growing at over 1,000 a day. Chris, if you add up the record profits, not the average, the record profits of ExxonMobil, Nike, and Walmart, tripled that number. That's about the annual profits from human trafficking, according to the U.S. State Department. It's gone up from 150 billion a year to 236 billion, according to the U.S. State Department most recently. So we didn't know what to do about it. So what we decided was we were going to do the same type of due diligence we do on commercial real estate deals and say no to almost everybody. We hear about all these amazing organizations. We found one that we think is really special, and it's called AIM. That's AIM, and their website's AIMFree, AIMFREE, aimfree.org. And we have raised over $900,000 for them over the last 3.5 years. I just went to one of their annual conferences. I got to speak at that. And I'm telling you, they're doing amazing things in Cambodia. And just yesterday, they announced they opened their new home in Belize as well. They're giving these little children a chance for a new life. They're not just sending them back to the street and saying good luck. They're spending $1,000 each. You can rescue a kid. For $5,000, you can rescue 5 kids and put 1 to 2 bad guys behind bars. But the problem is it costs about $20,000 per kid per year to house and clothe and feed and give them counseling and give them job skills. They do all that, and they do an amazing job. aimfree.org.
So folks, we're going to put that in the description, aimfree.org. If you want to give, doesn't matter how much, just giving is giving. But just remember, $1,000. How many kids does that save?
You can rescue 1 child for $1,000.
And then 5,000 gets 5. And then obviously they help the children get on their way instead of just sending them back and maybe having the risk of them repeat that. So aimfree.org. And then where do people find your books? Just Google you or Bigger Pockets?
Yeah, they can find the books on Amazon. The best way to get stuff from us is go to our website, Wellings, WELLINGS, wellingscapital.com. And you can get some free ebooks on mobile home park investing, self-storage investing, and more at wellingscapital.com/resources.
Love it. And so your funds are still open and still raising, correct?
Yeah, we actually next week we're opening 2 new funds, a Wellings Evergreen Fund, which is an income fund, and then a growth fund that doesn't pay dividends, but like Berkshire Hathaway, it compounds internally for 10 years.
Fantastic. And just based on the thing you talked about, your fundamental analysis, how many deals you look at and the focus on intrinsic value, folks, I think that would be a wise thing to do. So look at wellingscapital.com and just, if you're looking to place some money somewhere, build on your diversification in this space, in the commercial real estate space, specifically storage, mobile home parks, affordable housing, then this would be something that I would highly recommend you look at. But Paul, what else, in the last couple of minutes we have, what else would you like to talk about?
I just think it's super important for investors to adopt this boring mindset because sure, it's easy for us, especially when we're younger, to look at these icons, whether it's Elon Musk, whether it's the Facebook founder, the Google founders, all these guys, but they had incredible providence, timing, luck. They knew the right people at the right time. It's easy to look at them and think, I want to just repeat their success. But the truth is, most of us aren't going to be able to repeat their success. Most of us need to look honestly at what we are good at and try to figure out, where can we fit in? What can we do? Because, and like I said earlier, I think I mentioned this, Charlie Munger said it's much easier to avoid people's mistakes than it is to replicate their success. And one way I'd recommend is just, again, whatever you're doing, look for intrinsic value. Jeff Bezos and the Airbnb founder asked Warren Buffett, they said, hey, your strategy is pretty simple, Warren. Why doesn't everybody just imitate you? And Buffett said, no. People don't want to get rich slowly. But here's the thing. Buffett's made 90 or 95% of his wealth after he was 60. He's about 95 this year. And if you took, now get this statistic, this is proven. If you took Buffett's stock price and cut it by 99%, so Berkshire Hathaway, if it was $100 a share, you cut it down to $1 a share, it would still wallop the S&P 500 by about 40%. That's somebody we should follow. And a way to follow that is look for intrinsic value.
But that's what I love about what you do is you're literally following Warren Buffett's principles. So there will come a day, hopefully not anytime soon, where Warren will be gone. Munger's already gone, Graham's gone. So, there will come a day where we talk about him in the past tense. And when that day comes, his followers, his people that took what he taught and ran with it and didn't think that it was boring, but said boring is good. Those are the people you want to invest with, folks, especially for the long haul. If you're chasing short-term returns, you're going to be what I define as the rich person. We've all met a rich person, and the rich person is often the next poor person. So what you want to do, folks, is you want to follow people that have built wealth. And the only difference between rich and wealthy is the wealthy have figured out how not to give the money back. That is the only fundamental difference between somebody who's rich and somebody who's wealthy. The wealthy just know how not to give the money back. So, Paul, you sound like somebody that I'd like to follow, somebody that my audience definitely can learn a lot from. So, folks, get on there. Check out wellingscapital.com. We'll put that in the description. And please, please, please remember what he said. Give from your heart and don't expect anything in return, and you will get everything you want in life. And you can start by going to aimfree.org and help some children. $1,000 helps one child, $5,000 rescues 5 children. Folks, that's all we got here for today. Thanks for joining us. Paul, thank you so very much for your time today. And I will definitely be following you, and I urge everybody else to do the same. Thanks for joining us for this episode of the Money School Podcast. We'll see you on the next one.